price, then you're on the right side of delivery more times than not. And the way that I do that is by utilizing X levels. Okay, so this is what I'm actually we're developing with Toodegrees and TFO. It's the half myth that you've been taught so far with ICT, and that is the principles of dealing ranges and what constitutes a dealing range, right? So we all know that a dealing range has an OT, and the optimum trade entry being 79, 70.5, and 61.8, right? A dealing range has more percentages within that range than most are aware of, and they are what I've called is X levels. Okay, so that's how I define them, and they are 38, 29.5, and 21, and they reside in the premium side of a dealing range. So every single dealing range has a low and a high mean threshold or fair value, and then it has your discount and it has your premium. Every single dealing range has that, and that is defined by those X levels. Okay, so your low 79, 70.5, 62, 50%, 38, 29, 21, 0. Okay, so the way that you utilize it is also key in terms of how a dealing range is delivered. And so the way that I define a dealing range is by a swing low, which puts in a new high that closes above a former high, creates your new dealing range, right? And that dealing range stays and remains valid until that low is closed below or above. So on the daily, this is our dealing range. If we pull out, this is the monthly. So if we go to our monthly dealing range, it looks slightly different because I've just been playing around with my fibs, but this is exactly the same thing, right? So you have your premium and then you have your discount. This is your monthly dealing range. So this swing low, which put in a new high closing above this high, is our new dealing range. And we have a premium and a discount on both sides of that dealing range. And so you can see how price here has come all the way back up to 21% on the monthly DR, right? So what I'm trying to say to you is that X levels enable you to dial in your PDRAs in where you are looking for your manipulation to take place. So a turtle suit trader is looking for the principles of accumulation, manipulation, for then distribution if you're bearish, right? This would be your M, this would be your A, and then your distribution. What I'm looking to do is trade out of accumulation, trading the very high, and I can show you my trades this morning in a minute, into the very high of my higher time frame point of interest. So my PD array, that is in alignment with a higher time frame X level. And there's absolute rabbit holes that I can go down and teaching with you, and I can't do it all in a 2-hour session. It's essentially what I teach inside of Red Pill Uni. But if you literally just look at this monthly range that we've created inside this daily in terms of what price is respected, you can see that it's very, very clearly 38%, and it's all gone all the way back up to 21%, right? So if you're a swing trader, they're great, but also you can dial down on a lower time frame to start dialing in your entries, right? So if we know that we're inside of a higher time frame premium, and we know simply just out of the principles of ICT that if price is inside a premium, it's more likely, and it's in the upper 25% of projected range, it's more likely to go and search for liquidity, which is why yesterday we were driving bullish. We were driving longs, right? So if we now look at this daily dealing range, this dealing range on the daily, these levels are still valid even during this day on the lower time frame. So if we just look at this day on the daily, and this is the OT of this range, because as we remember, price hasn't closed below, so it hasn't validated a new bearish dealing range. All of these levels here would provide you opportunities to start framing and looking for your entries long, right? So here you had 62% on the daily. In here you had 79% on the daily. So they remain valid until price either closes above or below. All right. And so there's various different ways that we can use it. So I was utilizing it this morning. So there's a general rule that X levels can also help you determine context of price and what price is more likely to do, right? So we know that we're inside of a higher time frame premium on the monthly, right? And the higher the time frame that X level dealing range is, the more weight that the price action has in terms of its delivery, i.e. it will be more aggressive from higher time frame X levels than it will be from lower time frame X levels. And the reason for that is because the higher time frames are where the institutions step into the market, right? So as you can see, we've manipulated up into this yesterday, and this is what now we're getting this aggressive distribution on CPI. This is where the institutions, the smart money, is now distributing their money. So inside of here, a little general rule of thumb is in between 38% and 62% of any dealing range is where you're likely to get price distortion or accumulation. So if you ever find yourself in between 62 and 38% of a dealing range, it's like a blanket sit on the sidelines. You do not enter inside of here if you're anticipating consolidation. What you do is you either wait to enter at 62 or 38 on the premium or the discount side of that dealing range. And again, you're then aligning, you're utilizing these X levels to frame your PDRA, your higher time frame PDRA at that level to support price. So today, for example, and my trades this morning, I'll just show you quickly. So these, can you see that? I don't think you can see that. There you go. So these are my trades this morning. So it was 16 out of 35, and then this came back and took my stop, and then on the other one, right on the high, 24.51, scaled out of 40.55. So the reason why I was taking those smaller ranges, obviously, because we had CPI coming out, and I didn't want to get caught in this wick. But knowing that I'm trading inside of the two, I call them 262s for easy, but this is 62 and this is 38, the premium and the discount side. So again, I'm always looking for my PDRAs at the low to support price. So if I'm bullish, so inside of here, right, inside of here, this is where I start looking to frame reasons why price would respect this area. This is all from yesterday. Don't worry about these X levels. These are from yesterday. Why price would respect this area if I'm looking to play a bounce, right, inside of here. So for those of you who've followed my content for a while, you'll know what my 3 drives is. Okay, so my 3 drives is 3 drives into a higher time frame point of interest, which took place yesterday, this IFED. And we're always looking for the lowest down close candle inside of drive 2, which is a hidden order block, right? In terms of 3 drives. So this wick on this 5-minute candle right in here is where price comes down to, right in here. Okay, cool. So price has now hit my higher time frame point of interest in alignment with my X levels. And if we go to this point in time on the daily, we were at 21% on the daily, right in here, 21% on the daily. Higher time frame point of interest, my X levels, my reason as to why price is going to respect this level. I've now got a reason as to why price is going to move into the high. There's other reasons as well. I can't go through them all today. I'll be here until like 7 o'clock at night in terms of framing context. But this is where you have a nucleus in price. So your nucleus, the way that I describe it, is a nucleus is a higher time frame point of interest in alignment with a higher time frame X level inside of a discount. Okay, that is a nucleus. And if you're then looking to trade in alignment with the daily bias, this is where you're looking to frame an entry. So hypothetically, we are bullish biased in this example, and we're looking to take price higher from our nucleus inside of a discount on the hourly time frame, albeit inside of a higher time frame premium, capitalizing on a scalp. And there was reasons why price would come and drive out these highs. none more so than divergences up on the highs, but that's a completely different topic. So what we can do when price gets down to our nucleus right inside of here, okay, say we didn't even take this entry, but we understand that this is the principles of a turtle suit, right? As I mentioned, we're always looking for the principles of accumulation, manipulation into our nucleus around a macro, all of these, and there's other bits and bobs as well. We can then look to take price using X levels back through the dealing ranges. So if we look at this range, and I get this might be a lot. You might be thinking, what? Whoa, slow down. And if you have any questions, just let me know. But as I've mentioned, every single dealing range has a premium and a discount side to it. So until that is broken, it is still valid. So right in here, if you miss your aggressive buy, which is right in here, this becomes your entry inside of the discount side of this same dealing range. So this is your nucleus, right? This is your trigger, your turtle suit, program initiated. What's the program initiating? It's around the macro, searching for liquidity, inefficiencies, and price. What's the context for price to come and drive out this high? Divergence up on this high, okay? So what we then do is, inside Red Pill Traders, we are then looking to take price back through the dealing ranges from our higher time frame point of interest, our nucleus, right? So this is our nucleus. We then go through the dealing ranges. So I always start on the 15-second, then the M1, then the M5, then the M15, then the H1, then the daily, weekly, monthly. I use no other timeframes. I don't use a 60-minute, 30-second, 90-minute garbage. I don't use any of that trash. I'd say that condescendingly, but I don't mean to. Like, if you use quarterly theory and all that stuff, like, all for you if it works for you. What I'm trying to show you is the way that I approach the markets. So this right inside of here is a discount on the 1 minute. The way that we handle it inside of Red Pill is we pay ourselves inside of a premium of that dealing range. And then we are anticipating, if we are anticipating, price to come and break that 1 minute dealing range, which is all the way up here, right? So if you have context for why price would come back up here, which we did, divergence on the high. All right, so if I just pull this out a bit so you can get a better indication. All right, this was the entry. This is the divergence. So ES putting in a higher high, NQ putting a low. Context why price will drive out this high, paying yourself inside of a premium, holding runners to take out this divergence, right? So what we can then do is go up our time frame. So we know that this is our 1. What we then do is go and look for our 5-minute dealing range. Because after the 1, what comes after a 1? A 5. Okay. So utilizing the principles that we've just spoken about on a 5-minute dealing range, right? We'd be anticipating, or we can even use the 15 because the 5 is the same as the 15, right? Price hasn't closed below this low, right? You see this low? So this high, which put in this low, which closed below that low, is your 15-minute dealing range. This candle at no point has closed below that low, right? It's not closed below that low, so it's still our valid 15. So this high to this low, right, becomes our 15-minute dealing range. And it doesn't become, it is. So what we want to be mindful is if price is breaking out of the 1-minute discount, breaking structure on the 1 minute, you always want to know where you're going into the higher time frame, because the higher time frame is always king. It holds more weight than the lower time frame, right? The lower time frame is key. And there's loads of supporting factors we can talk about: context, schematics, all of this stuff aligns you with price. My CPI model, for example, taking both sides of a 15-minute out, but just purely on the principles of just trying to make sense of X levels for you. Going all the way back up to mean threshold on a 15. So you have now taken your price from a nucleus, discount on the 1, breaking the 1 into a 15-minute premium. What does this 15-minute premium fair value align with? Well, it aligns with 38% on the hourly, right? What do we talk about? Higher time frame holds more weight. It holds more weight the higher the time frame. So inside of here is where you'd be looking for, okay, well, what PDRA do I have here to support price? And there's honestly, there's so many different things that you can layer on top of this. One of them is schematics, in terms of if you're anticipating continuation in a sell day, you'd anticipate price to come back into 50% of the London dealing range, which will get you back up into here as well. So there's loads of different layers you can layer on top. I'm just purely talking about X levels for now, right? Inside of here, what do we now have? Well, we've now got a turtle suit on the high into our higher time frame point of interest. What did we have here? Mark, this is my entry today that I've just shown you. What is this? 15-minute volume imbalance, supported by this order block, right? There's your turtle suit. Okay. So same principles. So now this low, when this low put in this high, that closed above the former 1 minute high, which as we know was this high on the 1 minute, right? Right? When price went and broke this 1 minute, going up into the 15-minute fair value, hourly premium, higher time frame is king, right? We now have a new dealing range on the 1 minute at a nucleus. Same principles. If you missed your turtle suit entry and you have all your triggers up in here, and there's triggers that I talk about, and basically I've got a super in-depth way that I look at SMT and SMT divergences, then this is your entry. So inside of here is where you start looking for your PDRAs, right? Have you noticed all of this is way before you get your little Twitter traders doing their 2022 OTE trash? It's way before any of that garbage, way before it, right? These little junkies looking for their, inverted fair value gaps, all that garbage. Like, it's way before all of that nonsense. Like, a turtle suit is a turtle suit. It's the very goddamn high. It's the very pinnacle. It's the very nucleus, the start of the sell program or the buy program. That is why I trade like that. And the reason for it is simple. If I'm entering here, my stop is 6 points. I have a 6-point stop. And I only have a 6-point stop when it is around the open, right? Below the open, it's 3 points. My average R to R is 7 to 1 R. And that's the reason, right? I don't mind if this, for example, comes out and stops me out because it's such a small loss. And I know that I have this just around the corner. So having a huge RR, right, with high accuracy, my accuracy currently is 68%, is what gets you the consistency, right? The key to this approach is that you have to be extremely patient. So I only take 6 trades a day. I'm not a trader who trades every single micro scalp, right? I take 6 trades a day at max, right? But this being said, like, if you were looking to get in, once you've got your turtle suit, for example, if this, and let me just go back a second. If this, for example, wicked and it took me out, I have 2 opportunities at a trade idea. So if I then get my trigger, say, for example, I get another turtle suit in here, ES fails to put in a higher high, I've now got a divergence on the high and a trigger, then I've got another opportunity to take that trade. If that stops me out, I'm offside. Okay, so I always take two trade opportunities at any turtle suit. So say, for example, I missed this or I got stopped out on this, right? I would then wait for price to get up into here to go short. So if we are going short inside of a premium on this 1 minute, in terms of the way that we trade inside of red pill, is that we always pay ourselves inside of a discount. And the reason why we do that And I mean the discount of the dealing range that we're entering on. So if we're entering inside of a 1 minute premium, we pay ourselves inside of a 1 minute discount. And the reason we do that is because we are trading without confirmation. We don't have any breaks of market structure. Yes, if you've seen a 15-second break of market structure, a 15-second leads to a 1 minute, 1 minute leads to a 5 leads to a 15 leads to an H1 to a daily, and so on. But if you're entering inside of a 1 minute, you have to pay yourself inside a 1 minute discount because you haven't got any confirmation of a break of market structure on a 1 minute, right? If you were trading this as, you know, someone who has to get a 1 minute break of market structure before your trade, well, you haven't got hope in hell, right? I'm already paid. Like, so 90% of the time I'm already paid before secondary entry traders get in. Before they even get in, I'm already paid. And that's the difference. So a secondary entry trader, which is essentially people who trade offset accumulation. So traders who trade pullbacks into, whether it be an inverted fair value gap, whether it be a breaker block, whatever it may be, you're essentially trading the offset accumulation. That's what you're trading, and there's nothing inherently wrong with that. But there's nothing wrong with that. Absolutely nothing. You know, if it's your model, you trade breaker blocks or unicorns or whatever, you're awesome, great stuff. But I'm just saying that your risk is way higher because your entry in here and your stop has to be above this high. So your risk is this. My risk is this, right? You extrapolate that difference. You extrapolate that difference over the course of a year, and it's extreme, right? The difference is extreme. Okay, so I also find that in secondary entries, which is more often than not where retail are entering, it becomes incredibly wicky and choppy, and so it's very difficult to trade with a super tight stop, which is why I trade the turtle suit very high. Okay, so let me just go back to yesterday, and I can show you how this works in principle, right? So yesterday that we knew that there was a we knew that it was a buy day, right? For reasons I've spoken about at length. Not inside of here, inside of Red Pill, is anticipating an aggressive buy. So again, using the same principles of this dealing range. Okay, so this on the low, this on the high. When this low put in this high that closed above this high, we had a new 1 hour dealing range. So inside of here is a discount, no? Right? It's a discount. So you always want to go long inside a discount, right? And we obviously had those highs which were set up here. These relative equal highs are way too sus. So again, utilizing the same principles that we've just gone through to frame your entries. So on a 1 minute dealing range. Now we traded this very low. Okay, so if you go and look at my Twitter profile, we traded, and I know a lot of people who traded this yesterday, but if you notice where I got in, okay, so this was my entry yesterday, 59.25 out at 97.50, right? That's where I got in. Most traders that I saw getting in were getting in here somewhere, right? Huge difference, like a 20-point difference. Okay, so the principles of a turtle suit. Now, inside of here, and this is I teach this inside of Red Pill, but basically, if you have engineered liquidity and you're anticipating a buy day, always look for a 15-minute order block underneath engineered liquidity, right? Wow, where are we? I've lost yesterday. Where's yesterday gone? Here's yesterday. Right, so here's your 15-minute order block underneath engineered liquidity. Boom, right? Here's your entry. Yeet skis, right? To the tip. You then want to obviously layer on top of that lower time frame PDRAs to support that. So you've got your higher time frame order block, your 15-minute order block, which it wicks into to a tip. This range here, some this high to this low is unmitigated. This is rebalancing an unmitigated range. Yeet skis, right? So if you're anticipating higher prices on a buy day, okay, you can take the daily range from the high to the low. And this is specific to a buy day. Wait for price to come back down into a discount to go low. Right. But if you miss this very low, what do you now have here? So you have this 1 minute dealing range. There's your entry. There's your discount. Okay, so if I just clear this for a second. Right, let me just clear that for a second. So what would you do if you're trading this, and here's your discount, here's your turtle suit, right? So I actually traded this turtle suit, right? But I was allowing it to go into that 15-minute order block. So I got in here. That was my entry, right? And there's reasons why I highly suggest you go back and look at your charts at this time yesterday. So go back to your charts and look at 529 yesterday and look what ES had done at 529 and what NQ had not. Right? There's a little bit of something for you to go and look at. But this little, you get a secondary turtle suit here into your POI. So once you've now got into your nucleus, your 15-minute, and you're anticipating a buy day, right? We're in the upper 25% of projected range to come and take out these highs. It's more likely price is going to drive out buy side than it is going to search for sell side liquidity, right? Same principles, flip your DR over. Not only that, we had all these quadruple top at 2,300. You serious? It was almost money on the floor. But you just flip the DR over, right? So you pay yourself inside of a premium. You enter inside of your discount. You pay yourself inside of a premium. God damn it! And then you're going to hold runners to come and take out this high. All right, cool, brilliant, amazing stuff. So how could you have got inside of this? And this is source for you. Okay, I'll give you a little lesson. I'll give you a little lesson, free on the house. If you want some sort of mail, catch up incoming, right? If you want to trade a buy day or a sell day, I'm telling you this is how you trade it. No ifs, no buts, no maybes. Your first one, okay, and I'll just give you a quick lesson on a buy day and a sell day. I'll give you straight out of Red Pill Uni. So on a buy day, and we'll just take a buy day example. During London, and I'll get to X levels in a bit, so bear with me. We're going to go the long-winded route. During London, it wouldn't have fulfilled your higher time frame point of interest. We did not take out these highs, okay? You're also going to wait for price to sweep pre-8:30 on a buy day. If you get a valid sweep, and a valid sweep would be sweeping a major pool of liquidity, and I suggest go back to your charts and look at 528.29 on this day, all right? This was not a valid sweep. If you get a valid sweep pre-8:30, okay, so you sweep liquidity pre-8:30, you measure this range, the very low to the high going into the open, and you seek a discount to frame an entry. Okay, so this is where you would have been looking to go long, all right, inside of a discount. However, this was not a valid sweep. Okay, so you would anticipate at the open price to complete that valid sweep, all right, which is to come and take out those who are trailing their stops, right? And this is where you get your higher time frame point of interest, right? Sweeping out this low in a buy day. Your other opportunities for a buy day are obviously inside your discount, flipping your DR over. Your next opportunity is either a breaker block or a unicorn if you get one on the high. Beyond that, this is the only way you trade it. Okay, and I'll get to it for you. In a buy day or a sell day, you do not chase on the 1 minute. Never, ever, ever chase price on a 1 minute on a buy day. I will tell you how to trade it, and it is so goddamn simple. It's unbelievable. And it's right in front of you, but people don't notice it. You are going to wait for a break of market structure on the 1 minute time frame, and you're going to seek either your 5 or your 15-minute dealing range X levels to frame an entry around a PDA that supports higher prices. You are then going to wait for your macro, and you're going to look for your turtle suit for trading continuation. So let me explain. If you missed all of this, and this isn't hindsight, this is how we trade inside a red pill. If you miss this and you're going, oh, God damn it, how do I get in this? Oh my God, I'm going to get in here. You start jumping in here. Oh God, this wicks you out. And you're like, I'm going to get in here. And this wicks you out. Or you're like, oh, this is, I'm going to chase it, bro. I'm going for it, bro. And then boom, it does this. You know, what's going on, right? And then it comes all the way down here. You're like, fuck, I fucking knew it was going up, right? How many times have you done that? Right? Just don't do it. What you do is you wait for a 1 minute break of market structure, and you're always going to be acutely aware of what your 5 and your 15-minute dealing ranges are. Okay, so let's talk juice. This low, which puts in this high, closing above this high, is your new 1 minute dealing range. No? Yes. Right? So this low, which puts in this high. So if you're your little, if you're DTFX, you love a scalp, oosh. Right? However, you're not going to do that if you like trading daily range, right? You're going to wait for price to break structure on the 1 minute. And you're not going to go, oh my God, there's a break of 1 minute structure, right? Let's look for an OT to go short. No. In a buy day or a sell day, you get an alignment with it. If you are proved wrong, that is far more valuable to you than it is to try and continuously short a buy day, right? But don't do it. Get in alignment with it and be proved wrong. Don't trade against it and be continuously wrong. That's stupid, right? So what we do, we wait for our 1 minute break of market structure, and we go to either our 5 or our 50-minute dealing range, and we find a PD array that is going to support higher prices around a macro. Okay. So we're going to take this range, this swing low, this candle, this low, this high, which puts in a new high that closed above the former 5 minute dealing range. Is what? It's our new 5 minute dealing range, right? Yes, sir. Okay, so we go back to our 1 minute. I lost my 1 minute again. Jeez Louise. Go back to our 1 minute. We're going to start searching for our PD array in a very specific location, right? We are not interested in here. We're not interested in here. We're not interested in here, here, none of that. The points of interest that you have are your X levels. That is it. These two regions. That is it. And that is where you're looking for your entries to support price. Okay, so I have a 5 minute premium. I'm anticipating bullish price, so price can go outside of a higher time frame premium. If price is bullish, it will go outside of a higher time frame premium, because especially if it's already done its manipulation, right? If it's already done its manipulation, it will go outside of a higher time frame premium. Throw into the fact you had this being a whole site number of 2300, and you've got every Tom, Dick, and Harry in here who's hanging on to the cliff, right, with their you know their shorts, and they're just moving their stop up. Oh, it's got to go now, right? The market isn't going to come back down here and let them mitigate their position. Hell no, hell no, right? Smart money sells at a profit, not at a discount. So if you're accumulating down here and you're in a buy day, price isn't going to come back here to sell at a discount, is it? Makes no sense. No, it's distributing to do and distribute inside of a profit. So these guys aren't going to be allowed to mitigate their positions if they were short, right? So we can start looking inside of here going, okay, well, what do we have in here to support price? Because it's all well and good having your X levels, but you have to have PD arrays to support price at that level. Okay, so this is our 1 minute, 1 minute. So I always go to the 5, and I'm looking inside here going, okay, what do I have in here that can support price? What do I have that can support price? Anybody? Anybody know what this is? This candle that trades through, this comes back down and back through. This is balanced price range. Okay, so balanced price range. All right, trick with balanced price range is mean threshold. Right? So with balanced price range, you're okay for it to go to mean threshold. You're okay for it to test the low. If it tests the low, price should now not go through BPR. If it does, you're offside. So once it tests BPR, and BPR is a fill of that range, if it fills it and moves off, price should not go through mean threshold, just as a little tip for you. But right inside of here is where it is mean threshold on this balanced price range. Okay, so on the 5 minute, that's cool. Where does that sit? Well, that's funny, isn't it? That's funny. 38% on the 5 minute. Okay, so now we go down to a 1 minute to start dialing in, right? What do we have on a 1 minute to support that 5 minute BPR? Oh, big fat 1 minute order block. Okay, beautiful. What are we always looking for as turtle suit traders? The principles of accumulation, manipulation for distribution. There's your entry. Once that takes place inside of a discount, that is where you get in. Price isn't going to go back through that low in a buy day or a sell day. It is not going to go back through that low. That turtle suit is the computer code being triggered to continue. It's not going through that low. So your job on a buy day or a sell day is not to trade against the trend. Your job is to wait for a breaker structure on a 1 minute time frame. You wait for it to come back down into a 5 minute X levels, whether that be a premium or a discount, to then trade your entry long. Okay, so many of you will know what an opening range breakout is. Often you'll get an opening range breakout, which is between 9:30 and 10:30. All right, where price comes up and then it comes back between 9:30 and 10:30. This would be a principle where you'd look for your breaker block inside of a discount. That is your classic OBR trade, right? Opening range breakout, schematic, market profile, whatever you want to call it. But in this side, this is an aggressive buy day going outside of a premium 5 minute BPR, 1 minute order block at 38% on a 55 minute dealing range after a 1 minute breaker market structure. Okay, cool. You don't believe me? Let's do it again. Do not short a buy day or a sell day. You wait for price to come back into a high time frame X level to go long. Okay, so you see all these candles. You're like, oh, God damn it, let's go, baby. Let's short this puppy. This level feels right. At any point in here, have you got a 1 minute break of market structure? No, is your answer. You wait for a 1 minute break of market structure. There's your boss. You're going to wait for price to come back into a discount. And obviously you need to start overlaying context on top of that. I can't go through all of context today on today's session, but why in God's name would you be entering inside of a premium during lunch hour when you know that the lunch hour is going to get swept for continuation of PM? I mean, if you don't know that, that's like bog standard ICT. It's just bog standard ICT. All right. If you're anticipating PM continuation, anticipate a sweep on the lunch liquidity. Right. So what we can do here, same principle, anticipating higher prices, right? We do not go short. We wait for price to come back down into a discount to go long, right? So again, this where becomes where you start searching for your PD rates. Nowhere else. Not in here, not in here, not in here, not in here, not in here. There. This is where you start dialing in. Right in there. Nowhere else. Okay, so we jump to our 5 minute. Back then you had a 15. Back there you had a 15 minute BISI. Five-minute order block. Sorry, not there. 5 minute order, 5 minute BISI. All right. A little trick with you for you guys is with BISIs on a 5 minute. Mark out the quad levels. Upper quad, institutional order flow entry drill. On a 1 minute. Inefficiently delivered range. What's an inefficiently delivered range, X? A range where price has not come back to 50% of that dealing range. Okay, so it's going to rebalance that range. So if you were waiting for 350, you would have just missed your entry by 4 points. Oh, boo boo. What's a boo boo? Right? Unlucky. Okay. But that's essentially how you trade it. All right. Same thing. This now new 1 minute dealing range. This low, which put in this high, and I took this trade yesterday. This low, which puts in this high that closes above this high. Right? Price going from a premium. Let me just get rid of this 15 for a second. Price going from a premium back down to a discount. If you're long, you're bullish. Outside of a discount, it's going to drive out that one. Right? Where did we end up yesterday in terms of X levels? Where did we end up? Hello. Hello. Hello, 21% on the 21% on the monthly, right? So and there's various different things you can look at, right? So for today, I shorted this. You're probably thinking, what? How in God's name did you know to go short of 51? Right. So this was my short this morning. Right. 451. How on earth did you know to go short right here? So I have different models. All right. So I have my approach to trading is discretionary to a certain element in terms of using X levels. Okay. But there's what I'm well known for is my ability to read context and schematics and then overlay market structure and the principles of a turtle suit entry on top of that. Okay. And then there's a mechanical approach in terms of the way that I enter and how I scale out of my trades. Okay, so it's very discretionary. However, I do have mechanical entries that sit in the same realm of X levels in terms of where they take place. Okay, so what I mean by that is I have mechanical entries models, but they still follow those same principles of X levels in terms of where they reside. Okay, so just give you guys a little lesson on one of my models, which is mitigation 62. So if you're ever going to trade a OTE trade, and this is different to X levels, what I'm about to show you, right? This is different to what I'm about to show you, is the low, you go to your 15-second chart inside of here, and you'll have a break of structure on the 15 seconds. So this here mitigates on your 15-second chart. So if your highs are mitigated, so this mitigated, what I mean by mitigated is prices come back to 50% of the high, the original manipulation. Price has no reason to go back through that high. It has no reason to do it. It has none whatsoever. So that's where you have the high probability mitigation 62. So the mitigation 62 model is once you see this mitigation, wherever the low comes in, you're looking for 62%, right? Wherever the low is. And if it doesn't reach 62, it hasn't fulfilled its objective. It's still open for price to come back up there. So you see this low, does price get to 62%? No. Does price get to 62%? No. Does price get to 62%? No. Does price get to 62%? So that right there was a mitigation 62 entry, right? Which is a specific mechanical entry that I have. But the reason why it's validated, right, is because it sits inside of a premium on my X levels, right? Right up here. So 29.5% on the premium side of this X levels, right? So that is one of my mechanical entry models, which is utilizing my X levels to overlay on top, right? Has anybody got any questions? Yeah, TradeX. This morning's ES 50-minute candle, 8:30 a.m. dealing range. Let's have a quick look. Yeah, absolutely. So yeah, absolutely. Yeah, nailed on. Okay, so this is your 15-minute dealing range for sure, 100%. Right. So this high, which put in this low, right, which closed below this low, is a new valid 15-minute dealing range. Absolutely. However, what you always want to be mindful of is the higher time frame is always king. You want to be mindful of that. Okay, so it's all well and good saying, okay, well, this is our 50-minute dealing range, but what has this actually fulfilled? What objective has that filled on the low? Okay, I haven't done any analysis. I've just been talking to you guys for like, I don't know, an hour or so now. Like, but if this low is your high time frame point of interest, sure, you can start looking for, you know, price to revert outside of that dealing range. So what you'd be looking at is this like 1 minute dealing range, right? So back here, you're now inside of a 1 minute discount, right? This high, this low, price hasn't violated either side. This didn't close above. This would be your entry if that was your higher time frame point of interest to go and drive price back up, right? Right? Just using this principle very, very quickly here, right? this little this discount here, if you are anticipating high prices, right? But if you were looking at this dealing range, this high to this low, right? You'd want to be mindful of, okay, what has price fulfilled on this low, and what has it fulfilled on the high, and what is your overall bias for price? Like if you're, and the reason why I say that is because if you are, for example, in here, you are bearish, right? And price is now manipulated at the high, and you've now got the discount side of this hourly dealing range, right? You've now got your hourly X levels on the discount side. But we know the flip side of, if price is bullish, it's going to go outside of a premium. If it's bearish, it's going to go outside of a discount, right? So now it's done its manipulation and it's distributed lower. This is now your discount on the hourly dealing range. Okay, so you'd want to be mindful of these X levels, or you could even have looked to frame shorts inside these levels. Okay, so what does that align with on the 15? Well, you've got fair value on the 15. Let's just remove this. Right? What do you have in alignment with it to start framing your entries? Okay, so I can talk you through my CPI model just briefly. So this is a potential area for short, and the reason why this is as follows. So my CPI model is as follows. So you're going to anticipate every single time with CPI your most relevant, and I'll show you it. This is let me just bring something up quickly. Where is it? Here we go. So can you guys see that? So this is just inside Red. So this is my CPI and PPI model, which is inside Red Pill Uni. So it's exactly the same thing I trade every single time when I'm trading CPI or PPI. I took my trades before CPI today. I traded inside of this. But what you're looking for is you're looking for your 15-minute pivot low and most relevant pivot high on the 15-minute pre-8:30. Both sides are going to get swept on data every single time. Your most relevant 15-minute high and low are going to get swept on data with CPI and PPI. Once price breaks outside and you have context for why price is going to drive out the lows, all right, you have context for why price is going to drive out the lows. You're looking for your breaker block on the lows for continuation. If you are bearish, if your price is bullish, you wait for it to go out the highs, you seek your breaker block on the highs or mitigation block for continuation, okay? Just so you know, it's not hindsight. So this 15-minute high, if I just flip this to 15, this is your 15-minute high, this high, which put in this low, right? Most relevant 15-minute high and low. It's going to get swept on data. So what does it go and do? Boom, sweep, boom, sweep. So then you're going to look for your breaker block or your mitigation block on the low for continuation, right? What does price go and do? Right into here. So that would have been your trade, right? Right into this breaker block. All right, that's essentially my CPI model, my PPI model right there. Right. So what happens with CPI and PPI is price will sweep the high, it will sweep the low, or vice versa. It will pull you back into the range going into the open, at which point it will reject either the breaker block or the mitigation block for continuation if you're bearish. All right. You want to be mindful of what your position is on the lows in case price wants to pull back. Right. But if you were literally just trading that range, boom, happy days. Happy days. Right. And just remember, you only need to find one trade a day. So I would say you need to trade every swing. Just find one trade a day, right? But utilizing X levels, you'll find trades absolutely everywhere once you learn how to use them properly. And the last piece of CPI model is as follows. I wouldn't utilize it in this example, but you take the data wick. You need a daily low. So you wouldn't be using it in this example. So say we were bullish. So go back and test your CPI models. And the reason why it doesn't work on the lows is because it's already taken out a daily low. So you measure the data wick, and you go to mean threshold, and then you go to your high of day, and you measure that range. And by the way, this is not mine, this is ICT's for full transparency. This little element here is not mine, it's ICT. And you go to 1 time standard deviation, that becomes your target every single time if you're trading CPI that way. So you have to take mean threshold with data wick to the high, go out 1 standard deviation. If you were bullish, that would become your objective. All right. No, that, yeah. The, I go to the most, correct. Sorry, you're right. You're right. It's the high of day, which is during Asia here. So you'd be right. You'd be right. This is in yesterday. So you'd be right in that example. In fact, it wouldn't work in this scenario. It wouldn't work in this scenario because essentially this candle would have to be below the daily low. Okay, then you measure then you measure that range. Sorry. Yeah, you're right. I thought that was in the day. It's not. Right. Same principle on the low. If that was inside of uh, yeah, you don't even have a low that you could utilize. But if you had like a low that was like here and this came in here, you'd measure this range and you go out 1 time standard deviation, that becomes your target. So you can utilize that only on CPI and PPI. Right. So if I just pull this back in, um, this is how I trade it. Right. So if I'm trading that model that I've just shown you, right, you're going to measure that data wick, which is from here, this data wick right here, down to the low. And then you're going to measure out 1 time standard div. And that becomes your target every single time. Every single time. So data wick, 50% to the low, measure out 50% to the low, 1 time standard deviation becomes your target every single time. Right, that's just a little bit of sauce for you on the side if you wanted to go and play around with that. But it doesn't. You don't have the conditions for it today. Right. So let me just have a look, see if there's anything that I can take at the minute. What I'm interested in. If you guys got any questions. Yeah, like it's such a huge part of trading, and it's easy to people to get caught up on Twitter with like what's the best model, and I will often say that and by the way, this is like textbook CPI model here. There's like there isn't a right or wrong. I don't really care how anybody trades. If you want to trade breaker blocks, that's cool. If you want to trade inverted fair value gaps, that's cool. Just for the way that I view the markets, like my job is purely to reduce risk where possible. And the only way you can do that is to trade the very high. And you can do it. Like people get scared of turtle suits like it's impossible. Like turtle suits is not impossible. It's the only thing I trade. I literally only trade turtle suits. That's all I trade. And the reason for it is super clear. It is where the sell program and buy programs are generated from. And so if you want to trade in alignment with clean price action, with the lowest possible risk, with the highest RR, it comes in the form of a turtle soup. It just does. right? So once you learn how to trade turtle suits, everything else becomes subordinate to a point where it's like it's not even interesting. Like if I see a breaker block, I'm literally already paid before the breaker block is created. Okay, and if the breaker block's created, I can parlay in and reduce my net position, and my risk is still tiny. So if you can just shift the way that you look at the markets from, okay, this looks pretty, right? This looks like what people post on Twitter. It seems right. And switch your thinking to, okay, how can I reduce my risk to the least possible amount, and how can I maximize my return to the most? You'll find that your profitability just skyrockets. Okay, because I often say, and I say this inside Red Pill, and it's really crucial. So the way that I teach is very straightforward. It's top down. Most people come to the market and all they learn is something that they found on Twitter or on YouTube, and they try and apply a time-based model, right? So they come into the market, they're like, oh God, I've learned how to trade a breaker block. Yeet, let's get some, right? And they're like, okay, every time I see a breaker block that's around a macro, I'm going to trade it. People who trade like this, no shit, they sit in this bracket where they are around 50% accuracy. And there is nothing wrong with that inherently if you know how to manage a trade. For example, if you can hold runs to the exact terminus, you don't choke it and all that kind of fun jazz. That's okay. But people who understand how to read context and schematics before time and your model, whatever your model is, and mine's turtle suits, this goes up into your 70% bracket. And so just to give you guys an indication of my consistency is 69.52 on my fundeds, right? That's my accuracy, right? So if you understand how to read context and schematics, it shifts you from being in this 50% bracket into a 60 to 70% bracket. And the reason being is it filters out so many of your trades. Like, not all the time is it just time model. Like, there is so much that goes before time and a model, and they are schematics and context, right? So a schematic, for example, as we were discussing earlier on, you have London close reversals, New York AM session reversal, Asia to London session Judas swing, 2 p.m. reversal, 1:30 continuation, yada, yada, opening range breakout, OBRs, like all of those. Your job, if you want to start getting really good at creating directional bias, and I do daily plans that are free for anybody that I write every single day, and they're currently 26 and 0. It's because of my ability to read context and schematics, right? And then all you're looking to do is apply your market structure on top, right? Which is basically utilizing X levels. Then you're starting to go into your time element, and then you're looking for your manipulation into your higher time frame point of interest, your turtle suit, which gives you your trigger for the buy program or sell program to be initiated to then deliver in alignment with that schematic, right? So there's very, very clear ways that I trade, and they are unbelievably mechanical, right? In terms of, for example, if I'm trading a New York AM session reversal, right? So hypothetically, let's see if we can find a good New York AM session reversal. So okay, so for example, on this day, okay, so if I'm trading a New York AM session reversal, what I'm always looking at is obviously a Judas to take place, right? So on Asia, a Judas to take place. And this is how like there's so much a rabbit hole I can take you down, but it's all of this stuff which separates you from the wheat from the chaff. It separates the average from the great, right? It's this detail, right? It's not, oh, that looks like a breaker block, right? Let's just trade the break block, right? There's so much more that goes into it in trading. Okay, so this sweep on the Asia low, this is your purge, and this is just an extension of a Judas. Okay, so what happens is on a New York session reversal during London won't fulfill your higher time frame objective. It will fulfill it during New York, and this is an extreme example. It will fulfill your higher time frame objective during New York. I know simply by trading the principles of a schematic, not even using X levels alone, that my first objective becomes 50% of the daily range. Every single time on a New York AM session reversal. So not even considering market structure. Like if I'm trading up here, because this is my high time frame point of interest, right, which was mean threshold on the daily, by the way, or fair value, however you want to call it. There's your turtle suit, yeet skis, sell program initiated. In the schematic of a New York AM session reversal, purge on the Asia low, Judas for distribution. This is London not fulfilling its objective, a shit ton of inefficiencies and liquidity. 50% of my dealing range, of my daily dealing range, becomes my objective. If Asia has not been swept during London, so for example, this didn't do this. If this was your low on Asia and London didn't sweep Asia and London doesn't fulfill its high time frame objective, you hold runners to take out the Asia low if London hasn't swept Asia. So all of these little nuances and ability to understand what a schematic is, because schematics are repeatable market profiles that happen all through the week. All through the week, they get repeated all the time. Absolutely all the time, they're repeated. Your job is just to wait for them to set up and you trade in alignment with them. And then you just overlay your market structure on top. It's so goddamn simple. It's unbelievable. Oh, no, welcome. I appreciate it. I don't use the 4 hour, but let's talk for an example, right? So this daily dealing range, as we were talking about previously, if price is bullish, it's going to go outside of a high time frame premium, right? So yes, here you've got this distribution in this sell-off, but where's it distributing down to? Okay, so this is where, you know, 38% on a daily. It's like, okay, well, what do I have in here to support price? This is where you start going through you start hunting for your PDRAs to support price. What would you have? What do you have here to support it? Right, back into this order block, fill on this BISI, fill on this H1 BISI. Right, this mitigation block that you have here, this is actually a miticorn, not an exicorn, but a miticorn. Right. So again, understanding if price is distributing, and this is the final the bit to it, I guess you need to understand, if price is distributing from your higher time frame point of interest, and as we mentioned from the start, higher time frame 21%, going outside this higher time frame premium, yeet, now it's distributing outside of a discount on the hourly. Where's it distributing to? Where's it going? Let's go back to our first point. Price is only doing one of two things: inefficiencies or liquidity in price. That's it. That's all it's doing. And it's doing that by moving from a premium to a discount on the X levels dealing range, right? So down here, and this is where you start combining all together. Well, macro, we are bullish. And by the way, I'm still macro for us to get up into 2,600. That's my ultimate objective. And so I'll put 26. It's still macro bullish, right? So unless price breaks and moves through this premium side in the daily, my bias is still bullish. Like it's not gone against that. Okay, so what you could have done, could do, is if you were trading my CPI model, which I've just taught you all, right, which is utilizing the breaker block, which would have been on ES, all right in here. You're now asking yourself the question: okay, where is price going? Right, what's it going to do? Okay, that's always what you're asking yourselves, right? So 29.5 on the daily up here. On NQ, slightly more accurate, down at 38%. This is where you start hunting for your PDRAs. You're hunting for your PDRAs at X levels, right? So once you get down into, guess what? If you were to utilize your 4 hour, right? You're now down the side of a 4 hour, 62%. Oh, so what would this be? What would that be? What do I call it? A nucleus, right? So you've just come back down to a higher time frame point of interest. You've left a higher time frame point of interest from a nucleus. You've traded the turtle suit, the sell program, delivering down to search for inefficiencies in liquidity and price, going down into a higher time frame discount. Price moves from a discount to a premium, or a premium to a discount, searching for inefficiencies in liquidity and price. That is it. Don't overcomplicate trading, right? Get in alignment with context, get in alignment with schematics, alignment with time, wait for your turtle suit, wait for your buy programs to be triggered. The rest is rosy, right? So same principle. If you are down here and you're like, okay, well, I want to go long. Guess what we can do? Well, we know that this is our 1 minute dealing range, right? This high, which put in this low. Guys, how many times have we spoken about this? And this is me just using a 1 minute. I can give you far more source than this, by the way, on other time frames. I'm keeping it highbrow for now. But if you purely just want to trade off a 1 minute, there's your entry. Where's your breaker block? Where's your mitigation block? Where's your inverted fair value gap on the 5 minute? There isn't any. You don't need it. Principles of what we talk about. Turtle suit into a higher time frame point of interest. Boom. There's other things you can look for as well that you should be looking for. I won't go through them here. But once you've fulfilled that objective, discount, pay yourself, premium, liquidity. After a 1 minute, where are you going to go? 5 minute. Our 5 minute is the same as the 1 because it closed below this low. After 5, where's it going? 15. Okay, so what would you want to be mindful on the 15? Well, it's this dealing range, right? The range that Pat was talking about. Okay, so we haven't closed below it, have we? No. So this high to this low. What would you want to be mindful of? Oh, hello, breaker block. Mean threshold on the 15. Okay, so now you're taking price from a nucleus, higher time frame point of interest, discount on a 1 minute, paid yourself inside of a premium, paid, holding runners to take it up into mean threshold on the 15 to get it back up into this breaker block, right? If price is bullish, what's this going to do? If price has fulfilled an objective and it's manipulated on the low, it will go outside of a premium on a dealing range. Premium X levels. Share with me. Share with me. You're with me. And all I'm saying is that you just literally need to find one of those a day. One. There's your turtle suit, right? It doesn't take much, right? It honestly doesn't take much. If you're trading micros, whatever, minis, who gives a shit? Like literally, if you just traded this here, 95% of traders on Twitter can't even do that. Literally take this range from 21 and you literally just bounced both sides on premium discount on this 1 minute dealing range. And you just took that, you're just starting out using X levels and you're like, oh, fuck me, just give me this source, right? Feed me, baby, right? You go in at 26 and you pay yourself at 58 or 60, right? You've just taken 34 handles out of the marketplace. You just need to find one of those a day. And if you're in here, sorry, and you paid yourself and now you're holding runners, now you're just laughing, right? Still, yeah, exactly. Still looking for their entry, going, oh, how do I get in on this? Like I'm out, I'm paid. I don't care. Like if this comes all the way back down here and comes into here or even takes out this low, I could not care less. Could not care less because I'm paid. Could not care less. Right? But if you're entering in here, for example, I don't know what you'd be trading in here if you were trading it. You know, you could go outside of here. I have other models which I use, like little tips and tricks. Let's see if there's one. For example, this CPI, this CPI at this swing high, this CPI below this pivot high when it's supported by order blocks is what I call an exicorn. Okay, it's my own form of unicorn. It's not a unicorn. It's not a miticorn. It's my own, which is a CPI below a pivot high, and you're anticipating range expansion, and you have order blocks inside of that CPI. Essentially, what you have is balanced price range. So price has no reason to go back below that low, and you'd have continuation to go step up into this high. But that being said, right, you're laughing because you already paid. This is all just Runnerville. But if you're looking for a secondary entry trader, where are you going to enter? You're going to enter at mean threshold in this order block because ICT said so. right? You're gonna enter on the highest up close candle in this breaker block because Joe Blogs on Twitter said so. What happens if it comes down to this lower candle? It's still validated though, right? Because the other guy on Twitter said the whole 5-minute candle is valid for a breaker block, right? So technically speaking, my stop's actually got below 350. Oh my, right? Like, how can you trade with that amount of ambiguity in your trading? Like, I don't know how you do that. Boom, there you go. Absolutely. So first and foremost, what I'll say with turtle suit trading, it has to suit you as a person. And so first and foremost, you can't be a trader who likes to scalp. If you like scalping, there's traders out there who can teach you how to scalp. Like if you want to go and do DTFX's model, you can do that. But if you want to trade daily range and you have the patience for that, then turtle suit trading can be suited for you. It can be a great model if you learn how to deploy it effectively. But the key to trading turtle suits effectively, and by the way, how about that for accuracy, right? In terms of the discipline that you need, you have to have the patience of a monk to trade turtle suits, because what you cannot do is chase price. You just cannot do it. So I am only interested in buying underneath liquidity. That is it. I have no interest in buying above liquidity. I don't want to do that because that's where the markets are distributing. So unless I'm entering underneath the market, okay, and so my principles are always to take internal range liquidity to go and drive out external range liquidity. I'm always entering in the internal range if I am bullish, or I'm entering in the external range if I'm bearish, okay? So if I miss this entry, there's one other rule that I have. It's if I want to know what my projected range is. Okay, so if my projected range was to get back up into that breaker block, as we were just talking about, at 50% of the M15 DR, and that was my trade idea. I eyeball this. I don't always draw it on my charts. And apologies, my charts are an absolute car crash at the minute, sort of making me tweak a bit. But if I always want to be entering, and this is an amazing tip for you if you trade turtle suits. I always want to enter. It does look like Dave, yeah. I always want to enter inside of the lower 25% of projected range. That is always where I'm looking to enter. If I'm not entering inside of the lower 25% of projected range, I am not entering on that trade. If it goes, I have this saying, it's a boo boo, you missed the trail, right? Suck it up, right? Don't chase price. If you missed the trade, you weren't good enough to take it, suck it up. Let the puppy go, wait for another opportunity. They will present themselves, right? So I always want to be entering inside of the lower 25% of projected range, okay? That is how I put a steer on what it is that I'm looking forward to trade. So if, for example, I have my turtle suit entry, and this is my higher time frame point of interest, my higher time frame point of interest has to be something which is alignment with context, schematics, X levels around a macro, and then I'm looking for a turtle suit, okay? And there's also elements of SMT, which is another thing which I've developed in terms of what it is, and it's this combination which triggers a buy or sell program, okay? So I'm always looking for those things at my point of interest, okay? Once that hits, I am hyper aggressive. I am entering literally boom. I am in, puppy. I'm goosh. I'm in. And my stop is 6 points. Okay. If I take more contracts, sometimes I'll open it up slightly. I'll go to 10, right? If I'm trading like, if I drop down to micros, I'll open it up, right? But it's 10 points. If you are 10 points offside on a turtle suit, trust me, you're wrong. Trust me, you're wrong. So I always want to have a higher time frame point of interest that I'm looking to frame an entry. This is what you're looking for. You're looking for your PDRAs around that level. Okay, so you start hunting. Okay, fill on the BISI. Oh, brill. All right, let's enter on a fill on the BISI. Right, 10-point stop. If I get stopped out, I have one other opportunity. Okay, so it can happen where, and it can happen where if price, say for example, I entered on a suit and I got a 10-point stop and price comes down and you get one of these horrible little wicks, right? And then off it goes. And I have a 15 seconds dealing range, and by the way, I execute on a 15-second time frame. So the 15-second comes before the 1 minute. If price breaks a 15 seconds and now my bias is still for price to move higher, like it hasn't been invalidated, I've just had a gnarly little wick. Say for example, I was entering on mean threshold of a BPR, right, and I have my stop too tight and it wicks my BPR but then goes back up, right, and I've got another entry at mean threshold, whatever, right, and I've got my 15-second break of market structure. I can then enter on a secondary on that 15-second as long as it is inside of 25% of projected range. And here's the source. So all secondary entries come after valid manipulation. All secondary entries come after valid manipulation. Okay, so here's my argument to secondary entry traders. And by the way, go down to your 15-second chart and look inside of here on your 15-second dealing range. So how I've taught you with X levels, go down into your 15-second and look inside of here. Okay, so you now know that this is valid manipulation into our higher time frame point of interest, into our nucleus, as that we, oh, Jesus Christ, that we talk about. All secondary entries come after that. All of them. Breaker blocks, mitigation blocks, inverted fair value gaps, you name it, come after valid manipulation. So my question to those who trade breaker blocks, and for example, if you were trading a 15-second chart, you have a breaker block in here. It's actually an hexacorn. Right in here, you have a 15-second hexacorn. So for me, this would still be classified as a turtle suit entry. If you traded in that, say, for example, you missed this aggressive entry, you're waiting for your 15-second break of market structure, which you had here. This is your hexacorn on the 15-second, right? However, what I will say, and that comes after valid manipulation, right? So after valid manipulation, there's your hexacorn, boom. So my question always is to people who trade secondary entries. If you are going to trade a breaker block, mitigation block, inverted fair value gap, you're obviously confident on that breaker block holding, right? Otherwise, you wouldn't trade it because that would just be ridiculous, right? So for example, if we looked at this breaker block up here, right? If you were trading that, if you were looking at this breaker block, most people would look at this and go, that's a breaker block. I'm going to trade that, right? What you need to understand is that all breaker blocks come after valid manipulation. So if you don't know why price has rejected this high, what is the very reason why price has rejected that high, why in God's name do you think you've got the confidence to trade a breaker block if you don't know what that high has done? Because, and this is the difference between context schematics, then going into market structure and time, and the filter that filters out the trash, right? So you can't trade a breaker block unless you know what the manipulation has done. Difference between the 60 to 80% to the 50%. The difference between knowing what valid manipulation is or not. And so if you do not know what valid manipulation is, how in God's name can you trade a breaker block? And they say, oh, well, this looks like a breaker block, right? Yeah, this looks good. This is what everyone talks about, right? High, low, higher, high, boom. What has that high done? So yesterday, for example, we could take yesterday as an example. I guarantee people had their ass fucking handed to them yesterday in here. So this high. Oh my God, we got breaker block. It's ICT's breaker block. Let's trade it. Right, we're at a macro, I think. What do you think? What do you think, Terry? I think he said this was a breaker block, right? High, low, finally broken through. Yeah, let's take it, right? Must be going now. Must be. How can you take that breaker block if you don't know what that is? And so my point is this, right? If you know why price rejected that high, or you wanted that high to be your high for continuation, why in God's name are you not trading that high? Like, Do you get my point? If you're trading this breaker block, you're trading this breaker block because you're confident that that is a high into a higher time frame point of interest, right? And you're anticipating distribution to go and sweep out high time frame liquidity. That's what a breaker block is, right? You're sweeping high time frame liquidity into a high time frame POI. You're breaking the backs of those who are trying to trade long, and you're going to search for liquidity on the low. That's what a breaker block is, a high probability breaker block. So if you are not going, if you don't know why it's gone there, you can't trade this. You can't. And if you do know and you've gone, okay, well, this is a valid high time frame point of interest. This is my exact high. I know that price is going to continue here because it's hit my higher time frame POI. Now we're in distribution cycle. It's going to run out this higher time frame low. Now it all makes sense, baby. Now you have an opportunity where if you had you had price accumulating below it, you have price manipulate into it, you have a potential for a breaker block entry, right? Right, because you know what the valid higher time frame point of interest is. So if I go across to today, where are we at? All secondary entries come after valid manipulation. That is your takeaway for today. So go down to your 15-second chart. That is your turtle suit into your X levels, filling this H1 BISI at 38% on the premium side, anticipating high prices, right? Even if it was to come and get back up into mean threshold on the 15-minute dealing range. And this is a little bit source for you guys. If price doesn't close below and you've got a dealing range, you're going to anticipate price go and rebalance that inefficiently delivered range, right? But once you have this valid manipulation into this higher time frame POI, all of your secondary entries come after that. So go to your 15-second. Inside of here is your breaker block. That is a high probability breaker block. You now know this is valid manipulation, right? Inverted fair value gap, high probability. Hexacorn, which is my model. This SIBI, order blocks, as I was talking about, balanced price range, continuation, to go fulfill that objective, which is to rebalance that 15-minute DR, right? It all comes after this, but you can't trade this, which I see so much on Twitter, right? You can't trade this unless you know what that is. You just can't do it. And the flip coin to that argument, well, is if you do know why price has hit that level and reverted, why in God's name are you not trading it? Why in God's name are you not trading it? That's my question to you. And that's why I say there's levels to trading. There's everybody who trades secondary entries, and I've got nothing against them. Nothing. All I say to those people who trade secondary entries is like, if you just tweaked a few things, you could literally exacerbate your trading. Like you could use this as an entry, a place to parlay into your positions. Like reduce your risk, dude. Like some people's risk I see on Twitter, and they're trading here, their stops on this fair value gap and their stops like below this low. I literally have a heart attack when I see that. How can you trade like that? Like your consistency just isn't there. You're not, I guarantee majority of them aren't profitable. You know, they'll post a pretty picture on Twitter now and again with a 50-point trade. Yeah, okay, but what about the other two which you lost? And you're digging yourself out of a hole. Like if you can have like a mechanical stop and a mechanical TP, and honestly, I've got a strategy for the easiest way. If like some of you aren't even funded, like the easiest way to pass the valuations, if you trade ES, just take 2 contracts and go for a 5-point TP every single time with a 2-point stop. If you take a losing trade, you half size and you mitigate your loss. That's how you trade. That's how you pass a funded account. ES, 5-point ranges, using these principles I've taught you. Take a 2-point stop, draw down, 5-point range, rinse and repeat. If you take a loser, half size, you mitigate your loss. It's so easy, right? Just do the maths, right? So if you take a 2-point stop on a $50 per point contract, your loss is like almost $200 there, give or take, right? If you're trading a 2 contracts and you take 5-point TP, right? That's giving you your $500 if you win. If you lose, right, you half size. So if you then win, right, you're going to get your 250, which mitigates your loss on your first trade. So essentially, you've got to be wrong 3 times in a row to be negative equity. It's the easiest way to grow an account. It's so simple. So simple.